Okay, so in today's session, we will start with the investment appraisal because in the investment appraisal in internal rate of return IRR, because in the previous session we already cover accounting rate of return, we cover payback period method, even cash flows, uneven cash flows, and third thing we covered is the net present value. So we already covered three methods related to capital budgeting or investment appraisal. And this session, we will start with internal rate of return. And after internal rate of return, we will move on to the next topic, which is topic 5, source of finance. Right? But before we start today's session, I need to ask you something. So can you please tell me who is a monitor? Who is a monitor? Can you hear me? Who is a monitor? Say something. Students, do you hear me? Yes or no? So can you please tell me who is the monitor? So he's here or not? He's not here. Okay. Anybody else is a class? Okay, anyway, it doesn't really matter who is the monitor. So the thing is that this week, I'm going to give you assignments. So as I mentioned before, for this course, we have no midterm exam. We don't have any midterm exam because universities are closed. We don't go to universities. So instead of giving you midterm exam, I decided to give you group assignments. All right, group assignment. Okay. Now, for this group assignments, you guys, you have to create a group. Minimum 3 students and maximum 4 students. So means 3 to 4. All right, not less than 3 or not more than 4. 3 to 4. Everybody understand? Everybody understand? Okay. So you have to make student group by yourself from 3 to 4. So now generally I decide a students group, but this time I decided for you to decide your own group members, right? Later on, don't tell me there, teacher, I cannot find any group members. All right. So as long as you contact with other students, so you try to make group with the 3 to 4 students. One group, minimum 3, maximum 4. Okay. When you decide your group name, you have to choose a letter from A to Z. Any letter between A to Z, all right? No other fancy names, not your name. So group name, like as group A, group B, group C, group D, all right? Group A, 3 to 4 students, group B, 3 to 4 students, all right? So you have, and please do not repeat the same name. For example, if one group member already choose A, please do not choose that A group name again. Did you understand? Did you understand? Yes or no? Okay. Now, this is the responsibilities of class monitor, but class monitor is not here, all right? So anybody from this class has to make a list of all students. I'm gonna show you. Please do not send me your group name, group members. Do not send me. You have to send to this student, your class student, all right? Maybe monitor or not monitor, I don't know. It's up to you who's gonna be a class representative or class monitor. You all have to send your group name and group members, all right? And this person will check that any student repeat the same letter or not. If yes, then this person will inform you. Or another solution is that you just tell them, your group member, this person will decide by himself who gonna be A, who gonna be B. It doesn't really matter A or B. It's just a ladder. It's for me too easy to find the students from A to Z, all right? So I'm gonna show you this student. He has to make a list of the all group members in an Excel sheets and need to send it to me, right? Let me check. Okay. So I'm gonna show you how it's look like. Can you see this Excel sheet? Can you see that? Okay. So you have to make a group like this, but it's not advanced management accounting. It's a financial management, all right? It's a financial management. And you have to tell me your class, which class you are, because we have two classes. Let me check what is your class name or something. Yeah, we don't have any specific name of the class. So just simply say that you are Thursday morning class. So Thursday morning, all right? So you write here financial management and Thursday morning class, because I'm also teaching another class which is on Monday afternoon. So make sure you tell me very clear which class you are. So Thursday morning, this is the student, the order of the student 1, 2, 3, 4, and this is your student number. All right, this is your student name, this is your date of birth, and this is your group, whatever group monitor will decide or you will decide. All right, so someone from you has to make this list. All right. So now tell me who gonna do voluntarily. Who wanna do that? If you don't decide, I will pick up someone from you, and that person has to do, because monitor is not here. Monitor is supposed to do that, but we need to decide today that who gonna make it. So means all the students. So for example, this student, he decided to make the list. All students need to send email your group member to this student, and this student will make a list like this and send me that list. All right. So can you please tell me who gonna do that? Tell me quickly who wanna do that? Okay, if you don't decide, I decide. uh, I want this student, not Khan. So can you please give me your email address? So I will inform this email address to everybody. Okay. So student, this is the email address. Can you see that? Do you see this email address? Please say something quickly. Do you hear me? So please respond fast. Don't let me repeat the same thing again and again. So you have to send email to this student. No, you have to send her email, your group member. All right, send email to this student tomorrow, before tomorrow afternoon. So means before 12 p.m. All right. And not make sure, if any student who sends you group member after 12 p.m., do not add this student in that group list. Take that student out and you send me the name of the student. I will reduce that student marks. All right. So this is all your responsibility. That not gonna ask you. You have to send email your group members name. Minimum 3, maximum 4. Everybody understand? Okay. So, and now she will prepare a list like this and send me on Saturday morning. All right. Now send me that list. You make Saturday morning, because Saturday afternoon we have a class. So in that class, I will confirm the name of the student by showing the list. Understand? So student, this is your responsibility to contact that student, not that student responsibility. All right, make sure you decide your group member and you send group member, and this student, you don't have to tell the group name. So this student, once this student got the information like this, so this student will prepare name by him or herself. All right, so you have to tell your student number, all right, your group member's name, all right, and your date of birth. You have to provide 3 informations to this student so this student can make a list. Understand? Say something. Okay. And this Saturday, we will also discuss about, next class, we will also discuss about your assignments. What type of assignments, how many questions, some rules, regulation, structure, the way to present your calculations or your work, your assignments, contribution of each group members in the assignment, everything. So we will discuss in the next class, right? So anybody has any question? Regarding the deadline, we will also discuss deadline in the next class, right? So anybody has any question? Okay, let's start if no question. And one more thing, that's maybe I will tell you later on this Saturday. So next, so we continue with the same topic. I guess it's a topic 5, right? Topic 4 or topic 5? Capital budgeting. Topic 5. Topic 5. We continue the previous topic, which is capital budgeting. So, so we continue with the next method, which is IRR. Internal rate of return. Internal rate of return. So this is number 4. Okay. Now, what is internal rate of return? So before we start internal rate of return, I want to repeat again net present value, because this internal rate of return depends upon net present value, right? So what we learned in the net present value that, so what we learned in net present value, we learned that net present value could be positive if present value is higher than initial investment, or net present value could be negative if initial investment is higher than present value, total present value. So we select or we reject. However, if both are negative, we reject both projects. If both are positive, then we will make selection on behalf of the higher NPV value. So whichever project has a higher NPV value, we will choose that project to make investment. Now, what if net present value is 0? all right? No positive, no negative. So if net present value is equals to positive, what will be happen in that situation? If net present value is equals to 0, then we will apply internal rate of return to make decision, right? Then we will apply internal rate of return to make decisions, right? So now how we use internal rate of return. So remember, internal rate of return we have to calculate. So this internal rate of return could be positive internal rate of return, and it could be a negative IRR, positive or negative IRR. If our IRR is positive, we will choose this project to invest. If IRR is negative, we will reject this project, all right? But IRR never equals to 0. It can't be 0, right? Never ever. What is the reason? So let me give you example that why IRR cannot be 0 to understand this statement. Now, what is IRR? For example, you borrow money from bank, right? You borrow money from bank. So you borrow at 10% discount rate or 10% interest rates, right? So discount rate or interest rate. Why do you borrow this? Why we borrow money from bank? Reason to borrow? Tell me. What is the reason to borrow? Why do we borrow? Do you hear me? Why do we borrow money from bank? Have money to invest something. Okay. The purpose to borrow money is make investment. All right. So when you wanna, so this is money. This is the money that we borrow. When you wanna invest this money, what do you prefer? Your investment rate of return should be higher than interest rate or lower than interest rate. Obviously, you prefer your rate of return must be higher than this 10%. So you will select the project where your IRR is higher than interest rate. If any project interest rate is higher than interest rate, the money at rate you borrow money, you will choose that project to invest it. All right, exactly, that's the meaning of positive IRR. So the idea is that when IRR is higher than RRR or interest rate, or let's say RRR, when IRR is greater than RRR, we will select this project because my my return is positive. So it means I'm making money. That's the purpose of investment. But if IRR is negative, which means IRR is less than RRR, all right? Then we will reject this project. But IRR cannot be equals to RRR. Why? Because RRR means your investment option that you are looking for. Investment option that you are looking for. So if you are borrowing from bank at 10%, you're borrowing from bank. If you want to deposit money in bank, you may not have the same kinds of interest rate. So you are looking for that kind of investment which gives you higher return compared to RRR. So by that reason, RRR cannot be equals to IRR cannot be equals to RRR because you never choose that project. You never choose that project in which you have no profit. You always choose project which has a higher profit. In other words, we can say that, let's say you borrow money from bank. Now you are looking for investment opportunities. So obviously you want to invest in stock market, has a different return. You want to investment in real estate market, has a different return. You want to invest in foreign exchange market, you have a different return. You want to invest in commodities markets like gold and silver and stuff, you have a different interest rate. All right. So different markets has a different interest rates. So it cannot be possible that all the same kinds of all the markets having the same interest. That's never happened because different factors affect the interest rate or rate of return that we are generating from that particular markets. By that reason, your IRR cannot be equals to RRR. So it's either positive or negative. So that's the very basic ideas to understand how we make a decision using IRR, right? Now, the question is how we calculate IRR. So remember, IRR means internal rate of return, which indicates NPV equals to 0. All right, I repeat, IRR give us the rate of return, which gives the value of NPV, which is equals to 0, not positive, not negative, right? So now we have a calculation. So how to calculate? How to calculate IRR? So we have two ways to calculate. One is a formula method, formula-based estimation, and second one is table-based. Right? Formula-based and table-based. So as I mentioned, following net present value, we will not study formula-based here. We will use the table-based, right? So now how to use a table? So formula is initial investment divided by total cash flows. Total cash flows. So initial investment divided by total cash flow. if you do that, you're gonna get some value here, all right? You're gonna get some value. That value maybe start from 1 point, or it start from 0.9, right? If value starts from 1 point, then we will go to NUT table. If it starts from 0.9, then we go to discount table. Right? Either NUT table or discount table, depends upon the value. Now, we have to find this value in our table, either NUT table or discount table. So let's say this is your table, right? This is your row, which is your time, and this is your columns, right? This is your columns, which is R, all right? So now we have to find, so R could be 5%, 10%, 20%, so on, right? So we need to find this R. We have to find it. So which means that R will be IRR, right? So now this is the table. We have values in the table, right? We have values in the table. So you have to find, let's say our value is, let's say if we calculate and our value is 0.786, this is the value. Now in this table, you have to find where is 0.785. For example, here is 0.785. So by following this value, you have to find the interest rate, which is 20%. So my IRR is 20%. So I'm gonna compare this 20% with the RRR given in your question. If your question says RRR is 21%, then we will reject this project. But if your question says RRR is 15%, then we will choose this project to invest in. All right? Now the question is, because normally table is very long, how can we find this value? Because it takes a lot of time to go through one by one value. So the basic idea is that in your question, T is given, time is given. If in your question, time is, let's say 3. So just you simply look at the third row. You just simply look at this row. Whatever value close to this number, we will choose that to find the R. If T is, let's say 5, then you will look at only 5 row to find the value which is close to, which is 786 or close to 786. So closest number, let's say here is the closest number. So that means your IRR will be this. All right, so you don't have to look at the whole table. Just simply look at that row. It takes hardly 5 to 10 seconds to find the value which is close to this value. This is the way to estimate the internal rate of return. Is it okay? Is it clear? Yes or no? Did you understand? Any question? No. If no questions, let's move on to the practice questions. And then make sure you use your both table, the table I sent you before, NUT table and present value. Make sure you open that file. And if that file doesn't contain the information or the value, then you can download from internet. So let me open the file, the lecture slide. So here is your slide. So let's move on to our calculations. So here is a question. So we assume that our interest rate, so which means RRR, sorry, RRR is, for example, 9%. RRR is 9%. So can you tell me which project we should select using IRR? So let's start with the next topic, which is topic 5. So I already sent you the slide so you can have a look. So topic 5, or sorry, topic 6, because 5 was capital budgeting. So topic 6. Topic 6 is a source of finance. Now, what does it mean, source of finance? Source of finance is the way to raise money. In simple words, what options company has to raise money. So this source of finance divided into 2 parts. One is internal source of finance, and second one is a external. Internal source of finance and external source of finance. Now, internal means the source of finance in which company raise money by itself. Company raise money by itself without anybody's support. All right, so this is called internal source of finance. So what options company has to raise money internally? For internal source of finance, the first way company has is a revenue. Company generate revenue by selling product and service. So you sell product and service. You may not depend on someone whenever you need money. You sell product and service, you raise money, and you use that money to expand the business or to invest wherever you like it. Second options or way that company has to raise money is a retained earning. Retained earning. Did you remember retained earning that we covered previously as well, I guess? Do you know retained earning? Yes or no? Say something. Do you know retained earning? Okay. So retained earning means whatever money left after paying all kinds of expenses. All right. Retained earning means money left. So second, internal source of finance. So this is internal source of finance. So the first one was sales or revenue, right? And second one is a retained earning. Retained earnings. So which means whatever company left after paying everything. So sales minus cost of goods sold, gross profit minus operating cost is a operating profit minus interest, tax, and preference dividend. Then we got net profit or net income. From that net income minus common share dividend. So after paying common share dividend, whatever money is left, that's called retained earning. Retained means whatever is left. So what is the purpose of retained earning? Again, reinvestment. Company gonna reinvest that money. So remember last time I said that if shareholders, they do not take the dividend, of course, common shareholders dividend, then company use that dividend to reinvest it. So which means if company is not paying common shareholders dividend, retained earning will increase. So which means company has more money to reinvest. So in future, company may give more dividend to shareholders if company is investing in a new project, right? So that is the ideas for retained earning. Third way or options to raise money is selling assets. If any kinds of assets which is not in use, company choose that assets to sell it, and whatever money company got it from that assets, company will reinvest in a business. So remember, that kind of assets is not the essential assets for your company, which is required to produce product and service. That's assets, mainly the assets which is not in use. Company don't use it, or that's old. Better company sell it, and the revenue company use it for reinvest. That normally we also do sometimes. Some kinds of items we have at home, so we have not been using that item for a long time. So what we do, we sell it, and then whatever finance we got it, maybe we invest somewhere else, or we buy something else that we needed. So that's exactly selling assets, right? So we have only 3 internal source of finance, right? Let's move on to external source of finance. External means outside. So now this external source of finance divided into 3 parts. We have 3 types of external source of finance. First one is a short-term. Short-term external source of finance, long-term external source of finance, and inorganic growth or inorganic source of finance. So we're gonna study these 3. Right. So let's start with the first one, short-term. Short-term. So remember, short-term source of finance are those finance which is company raised for maximum 1 year. So the maturity dates for these kinds of short-term source of finance is a maximum 1 year. Maximum 1 year. So after 1 year or within a year, you have to return that money back wherever you raise that money. Now, what are the short term? First one is a bank loan. Short term bank loan. You know bank loan. We borrow money from bank for maximum 1 year. If you're borrowing money from bank for maximum 1 year, that's called short-term external source of finance, because bank is external, all right, outside the company, and then company raising money by taking support from the bank, all right? Second source of finance is a overdraft. Overdraft. We also call it commercial credit card. Commercial credit card. Now, I hope you know what is credit card. If you do not know credit card, so let me explain what is credit card. For example, when you have a credit cards, under credit cards, bank give you limits to withdraw money. So let's say your credit card limits is a $5,000. So it means you can use up to $5,000 by using this credit card. So which means bank is lending you up to $5,000. For example, in your bank accounts, you have your own $1,000 and 5,000, which is credit card. So which means now in your bank accounts, you can use up to $6,000. So you can do shopping up to $6,000. For example, you go for shopping. In the 6,000, you spend 1,500. So what does it mean? you use 1,000 your money and 500 from your credit cards. All right. So now this $500 you have to return back to bank within a period. It depends upon bank to bank. So normally it's 3 months to 4 months, maybe sometime 2 to 3 months. So let's say it's 90 days. So you have 90 days to return money back to bank. So 90 days means, of course, within a year, 3 months. If you return that $500 from bank, you use from bank, and if you return within 90 days, it's okay. You don't have to pay any interest if you return within 90 days. But if you return, take more than 90 days, then what will be happen? If you are taking more than 98, then you have to pay interest on this borrowed money, which is $500. And that interest rate is quite high, maybe 20%, 25%, 30%, 40%, it depends. So nobody likes to pay high rate of interest. So that's why everybody try to return money back to bank within a 90 days. So that's called a credit cards, right? Now, company give credit cards to the retail customer, like as you and me, individual people, all right? And company also give credit cards, banks also give credit cards to the company. Why? Because company, they also open their bank accounts, not just only you and me, all right? Company also open their bank accounts. So bank also give credit cards to company to spend money for company purpose, for company supplies, company material, company assets, so they can use credit card. So when bank give credit cards to company, that's called CCC, commercial credit card. All right, so that's the ideas. And commercial credit cards, again, you also borrowing money, like as I give example I gave you, for maximum 90 days. That's called overdraft. Right. Is it okay? Any question? Anything is unclear? So let's move on to third one. Third source of finance is a trade credit. Trade credit. Trade credit means when you purchase supplies or purchase raw material from supplier on credit. On credit. On credit means you do not pay right now. All right, means you will pay later. By on credit means you are not paying right now, you purchase raw material and you pay later. So what does it mean? In other words, you are indirectly borrowing material from suppliers, and then you do not return material back, you return money in exchange of it. This is called trade credit. So in simple language, when you purchase material from supplier without making a instant payments, unlike supermarkets, like we go to supermarkets, we don't buy from credit, we buy and we pay right now. But in companies, company make a relations, in order to make a relation with supplier, or supplier want to make relation with companies, so suppliers sell product to companies or supplies to companies on credit. All right, so this is called trade credit. And of course, the time to repay money back to supplier is a maximum 1 year. So company has to return that money back to supplier within a year, right? So this is called a trade credit. Next, number 4. Number 4 is a hire purchase. Hire purchase. Now, what is hire purchase? So I think you also do that. Hire purchase is also possible in Vietnam. Now, what is that? For example, you go to a laptop shop. You want to buy a laptop. Laptop cost is $800, right? So you need to pay $800. But right now in your pocket, you have only $500. So is that possible that you buy laptop which cost is $800 by paying $500? Yes, it's possible. Now what happened? You pay $500 for $800 laptop. How many left? $300 are left. So now what company, laptop company or the selling shops, what they're doing, they are ask you to pay this $300 in installments. Installments means in parts. Let's say company decided to pay you $30 in 10 months. 10 months. So what does it mean? You have to pay $30 per month in order to return that $300 back to bank. So after 10 months, that laptop, you become owner of that laptop, but still you can use it, right? So this is called hire purchase. Is it happening in Vietnam, right? We also call it EMI, monthly installments, every month installment or easy monthly installments. Is it happening in Vietnam, right? Hire purchase? Yes, it is. So that's called hire purchase. So which means you buy assets or items, by making or by giving down payments. Down payments. Down payments means initial money, like as here, 500. 500 is a down payments. So you're making some down payments now, and then you bought assets, and then you can use that assets, and then you have to return money back to bank in small parts. This could be monthly, it could be quarterly, this could be half yearly or yearly. It depends upon the value of the asset. But generally, the maximum period of such kinds of hire purchase assets are 1 year. All right, so this is called a hire purchase. Now, number 5. So number 5, short-term source of finance is a factoring. Factoring, right? Now, factoring accounts receivable. Factoring accounts receivable. All right. Now, what is factory accounts receivable? So, for example, this is company, and this is a customer, right? This is a company, and this is a customer. So company sold product to company, but company sold product on credit. On credit means companies sell now and receive money later. All right. So what does it mean? This customer become accounts receivable, same like as accounts payable, opposite of accounts payable. So this customer become account receivable. So which means company need to receive money from this customer in future. All right. Okay. Now make sure you listen carefully. So now, for example, company sign contract with this customer to return money back after 5 months. So after 5 months, company will receive money from customer, or customer will pay after 5 months to company, right? Okay. Now it's already 4 months. All right. It's 4 months past. Now company needs money for invest somewhere else. So company found one investment opportunity. So company need money. So company contact customer and company ask, can you return money to me now? And what customer will say? No, because now just 4 months, still 1 month left. All right. So customer will say, no, I can't pay you right now because according to contract, I'm supposed to return money to you after 5 months. But company really need money now to make an investment. So what company will do? Now company will go to bank. Company will go to bank, not to borrow money. Company will go to bank to mortgage its account receivable because you sign a contract. So that contract indicate that this person is the account receivable. So now company will mortgage. Company mortgage its account receivable. And in exchange, so company will mortgage account receivable to bank, and in exchange, bank will supply money. So company got money and company will invest. That's company needed. All right. Okay. Now, when 5 months are completed, then this person do not need to return money to company. Bank will contact to this person to get that money back. Why? Because company already transfer all the rights to receive money from account receivable to bank. Now bank has a right. Bank has a right. Bank has a right to receive money from accounts receivable. So bank will take money from account receivable. So this kind of triangle relations or triangle activities called factoring. Right? Now the question is, what profit bank has if bank do that? So always remember, if account receivable value is $1,000, bank will lend less than $1,000. For example, 900. For example, bank will lend $900 to company. And when bank receive money from this person, bank will receive $1,000. So as a result, bank has $100 profit. This is called factoring account receivable. All right. Is it clear? Did you understand? Okay. So let's move on to number 6. The last short-term source of finance, external. 6 is a lease or leasing. Do you know lease? You know leasing or lease? For renting, yes, it's for renting. But you can explain it. Under lease, you have right to use the assets, but you don't have right to sell, but not sell. You have a right to use the assets, but you don't have right to sell the asset. Like for example, if we are renting a room or renting a house, we have a right to use it because we sign a contract, but we don't have right to sell that house because we are not an owner, right? That's the meaning of leasing. Now, there are 2 types of lease. One is a operating lease, and another one is a finance lease. Operating lease is a short term, and finance lease is a long term. So finance lease is a long term source of finance. So but I'm explaining right now, so it's very clear for you to understand if I explain now. Now, what is operating lease? So remember, under operating lease, so remember, under operating lease, risk and reward. Risk and reward do not transfer. Do not transfer from lessor to lessee, right? Under operating lease, risk and reward do not transfer from lessor to lessee. Lessor means owner, and lessee means customer or users who use the assets, right? Owner and users, or owner or tenant, landlord or tenant, you can say that. Now, risk and reward. Now, risk and reward. What does it mean, risk? Risk means all kinds of cost. And reward means all kinds of profit or benefits. Profit or benefits. So risk and reward do not transfer. Now, what does it mean? For example, you go to a hotel to stay in hotel, right? You rent a hotel room. Now, if it's in hotel, your air condition broke down, technical fault, not you break it. If air con broke down, now who will fix that air con? Lessor or lessee? Means you will fix because you are a lessee, or owner will fix because he is a lessor. Who will fix? Lessor or lessee? Lessor, all right? Lessor will fix. So what does it mean? Risk do not transfer from lessor to lessee. It belongs to lessor, risk. And the profit, whatever profit, for example, the price of hotel increase, who gonna make profit? Lessor or lessee? Again, lessor will make profit. So risk and reward belongs to lessor, do not transfer. All right, this is called operating lease. All right, now finance lease. Under finance lease, risk and reward transfer from lessor to lessee. Transfer, yes, it's transfer. So which means risk belongs to users and reward belongs to users under finance lease. All right, now what is the example of finance lease? So finance lease example is, for example, you hire an office, you're renting an office, or you're renting a shop in a mall like Wincom Mall or Diamond Plaza. You're renting a shop. If you're renting a shop, you have to fix many things in that shop. Maybe it depends what kind of business you want to do. So you have to spend for air con, for tables, for furnitures, for floors, for walls, right? You're going to spend money on it. If air con broke down, users has to fix it because that's users, because owner going to give you empty space. You can do whatever you want. So all the expenses you have to pay by yourself, depends upon your business. And reward means you can do anything, whatever you like. You can open a coffee shop, open a restaurants, open a clothes shops, open a mobile shops, open a shoe shops, anything you like, you can open. Nobody gonna stop it. So that's reward for you. So this is called finance lease. right? But in hotel, you can't do that kind of business. If you're renting a room, you can rent a room. You can't open any business in the hotel room, all right? So that is the ideas for finance lease, right? So understand, yes or no? Operating lease, finance lease, clear? Okay, let's move on. If any questions, you can stop me in middle, all right? So that's all about short-term source of finance. Short-term source of finance are finished. Now we move on to the long-term source of finance, which is external, number 2, right? Long-term. Under long-term, of course, the first one is a finance lease. Finance lease that I just explained to you here. Finance lease, long-term. So operating lease is a short-term. So I don't have to explain finance lease. Second one is a debt finance. Debt finance. Debt finance means you borrow money and that's become your obligations or that's become your liability, right? So now they are, so debt finance means loan, right? Loan. Loan. So there are 2 types of loan. I think this thing I already explained you, but I repeat again. One is a secured loan. And second one is a unsecured loan. So we are talking about long-term. Remember, long-term loan, not short-term. Unsecured loan. Secured loan is when you have to mortgage your assets to borrow from bank. That's called bank loan. All right. You mortgage your assets to borrow from bank. That's called a secured loan. Unsecured loan means you don't have to mortgage your assets. So what is the example of unsecured loan? The example is a selling bond. So the people who are buying bond from you, that people will become bond holders. Right? So debt finance means borrow money from bank or selling bond to bond holder. In exchange, you get the money. All right? So bond holders, we have, remember, 2 types of bond: corporate bonds and government bonds, state bonds, right? So this is called debt finance, right? So this is your liability. Both are your liability, right? Long-term liability. Third one is a equity finance. Equity finance. Equity finance means you're getting money from shareholders, right? Shareholders. And you know that we have 2 types of shareholders. One are common and another one are preference. Common shareholders and preference shareholders. Of course, common shareholders are the owner, and these are quasi-debts, as we studied before. All right? So this is the ideas for equity finance. Equity finance is finished. Long-term source of finance, finished. So any question? Any question? Long-term source of finance? Anything is unclear? Okay, so let's move on to the last source of finance, which is inorganic. All right. So number 3. Inorganic. Inorganic source of finance. Now, here inorganic means M&A. M and A. M&A means merger and acquisition. Merger and acquisition. Now, what is the difference between merger and acquisition? So remember, under merger, A plus B become AB or BA, right? And under acquisition, A plus B either A or B. So acquisition means acquire, buying. Right? So that's called mergers and acquisition. So merger and acquisition are inorganic. The meaning of inorganic means, in simple words, inorganic means with the help of others, with the support of others. So this is the inorganic growth. Why? Because A support B or B support A, or A support B in acquisitions. Right? So they are supporting each others in order to get bigger. So now we talk about mergers. There are 3 types of merger we have. 3 types of mergers. So we have 3 types of merger. One is vertical merger. Second one is horizontal merger. And third one is conglomerate. Conglomerate. Vertical merger, horizontal merger, and conglomerate. Now, what is vertical? Vertical means like this. So when one company are acquiring or merging with another company, and if it's vertical, of course, both are not at the same level, right? So vertical means A merge with B. So of course, both are not at the same level. Both are not at the same level. At the same level. Same level means maybe they have different customers, different product, different markets. So they are not competitors at all because their market different, customer different, product and service different. This is called a vertical merger. So what is the example of vertical merger? So the example is, for example, we have a supplier and a company. Supplier, a company. For example, the company is about steel manufacturing. I mean, company is about car manufacturer, right? And they require steel, and they buy steel from supplier, and supplier have a steel business, right? Steel business. So when company need raw material, company will contact to the suppliers, all right? And you know that they are not competitor. Why? Because supplier customer are different than the company customer. Company customer who want to buy car, all right? And supplier customer who want to buy iron or steel, right? So that's why they have different markets, Different customers, different products, steel and car. Right? So when A and B company will merge, so every time company B don't have to purchase raw material, right? So company will make its own raw material because it's merged with supplier, and company use its own raw material to make its car, make its product. This is called a vertical merger, right? Now, horizontal mergers. Horizontal merger is like this, horizontal. So which means both A and B. This is called a horizontal. Right? This is called horizontal. So horizontal means same level. Both have a same level. Same level means maybe same customer, same product service, and maybe same market. So when they're gonna merge together, this is called horizontal mergers. All right. So what could be example? So let's say mobile phone companies, two different mobile phone companies, two different telecommunication companies. Let's say Mobifone and Vinaphone. So both are telecommunications. Both provide SIM cards. Both provide telecommunication services, right? So if both these Mobifone and Vinaphone, when they're gonna merge together, this is called horizontal merger. All right? You understand horizontal and vertical, the difference? Okay. So let's move on to the last one, conglomerate. Conglomerate means the merger between two companies, they are not connected directly or indirectly with each others. So what does it mean? It means they don't have same supply, same product, same service, same market, even though they don't provide service to each others. So no